Welcome to the Select Board meeting on Tuesday, November 23rd. We also have in attendance tonight members of the School Committee, the School Building Committee, the Finance Committee. Hope I haven't left anybody out. As we always do, we'll start with the Pledge of Allegiance. The Pledge of Allegiance
to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
So the goal of this part of the meeting is really to talk about the first borrowing for the middle school project. And to sum it up, just to frame the issue from my perspective, interest rates are at, historic's probably not the right word, but historic lows. Our last borrowing as a town was in the 1% range. We're not gonna get that, but, if we can get a 2% rate more or less now, is it worth borrowing as much money as we'll need for the next 3 years? And we'll talk about the pros and cons, or should we not borrow that much to begin with? So from my point of view, that's the basic issue, and then there's a lot of side issues related to that. So when we start the discussion, I'm gonna go first to select board members, and then I'll go to any other board member for one of the other boards that has an interest in asking a question or making a comment. Select board members Jim O'Neill and Nancy McKenzie are both stuck in traffic and will be here as soon as they can. So Jim, let me turn it over to you.
Sure. So first off, I'd like to kind of run through the memo that I prepared earlier today with the help of Jody and Lisa and Peter Frazier, who's our financial advisor. So if you're okay with it, I can walk through. I can kind of skip the pros and cons. We can talk about that towards the end. But some items that we're obviously considering is whether or not to go ahead and borrow $20 million versus a $50 million borrowing. Both are pretty substantial borrowings, and I want to talk about the impacts one way or another on these. Obviously, my first initial question was, well, are we going to get a better value going out to borrow for $50 million versus $20 million? The answer was no today. The advisors thought that both borrowings would bring in about a 2.5% interest rate when we go out to borrow for those, probably come January. We've also provided a chart in your packet here that shows what a $20, $30, $40, and $50 million borrowing over the life of the project looks like as far as costs. We've also provided and I believe I've sent this information to everyone. We also made 50 copies. I didn't know how many we'd have here in attendance. What's the projected impact for the taxpayers at $20 million versus $50 million? And what I went ahead and did with the help of Dennis Fliss, our town appraiser, is I updated the tax impact chart, this one, that shows, we presented it to town meeting members, which was the $439 figure that we talked a lot about. So what I showed here is what's the impact of $20 million versus $50 million to the average homeowner in Walpole. The average homeowner at $20 million would pay just about $100 extra in taxes, or that if we go with the 50, it's $250. And that's with the lower interest rate. What we talked about at town meeting leading up to it was an interest rate of 3.5%. Obviously, we prefaced all that by saying that we were being very conservative leading up to that, and that conservatism has really paid off. We're looking at possibly a 2.5% interest rate borrowing. I also asked Peter what's he seeing right now for borrowing out there in interest rates. I think you told me Salem recently borrowed at just around 2% or so on a large-scale project for over 30 years. And what else do I have here? And I tried to break out, Glenn had asked me a specific question about some of the pros and cons of borrowing 20 versus 50 million. What's the impact to the overall taxes in town? What are we going to pay in interest rate? So Glenn, I don't know if I exactly answered your question, but what I did here is we ran a couple of different scenarios, and that's item number 9 in the back of the packet here, that shows what the interest rate is at 2.5% compared to 4%. Now, Peter reminded me, we don't know what the future holds. We don't know if the interest rates are going to hold at 2.5. They're going to increase, decrease. And I wasn't happy with that answer, and I'm not happy giving you that answer, but it's the truth. We really just don't know. So we agreed to give two scenarios here, the 2.5 that we think it's going to be come January, and the 4%. And we ran it at 20, 30, 40, and 50 million. So you could see the difference, Glenn. So if we went ahead and borrowed 20 million today, what the impact will be. So overall, with principal and interest over 30 years, that impact would be $28 million. If we went ahead and borrowed 4%, possibly a year from now, at the same amount, the impact is $34.7 million. So it's a good swing right there. And I presented these numbers to you so you could kind of play with it a little bit, Glenn, because I know you were asking, what if we borrowed 20 now and 30 a year from now? What's the impacts there? So you can figure that out. So that's really it. So what we're looking for tonight is some direction, because obviously we need to work together to get the bid packages ready to go out to bid, to work with the various bonding companies so they can give us an updated rating. And then they send the package out. I think we're going to send that out in early January and get the select board to award the borrowing sometime in late January. So it's a tight time frame. I know January seems far out, but it really isn't, and December is going to fly by. So that's it for now.
Let me go to Peter. Peter, is there anything else you want to do to frame the issue from our perspective, or?
Sure. You know, unfortunately, it means getting into the weeds somewhat. But part of the,
Oh, yeah, come up so that they can hear you on the microphone, so.
you know,
Yeah, you too, Jody. Please.
there are any number of factors that have to be considered anytime you come to market with a bond issue. And one of the items, whenever you're issuing on a tax-exempt basis, is that you have to have a reasonable expectation that you're going to spend at least 85% of the proceeds within 3 years. And that may not seem daunting, but it's one of those items that you look at to say, okay, what's the cash flow of the project? Are we going to be able to, do we reasonably expect that we're going to be able to spend those funds? Another consideration has to do with arbitrage, and that is that under certain market conditions, the town can borrow at a rate that's so low that they can park their money in the bank, the proceeds of that borrowing, and actually earn a rate higher than the rate at which they're borrowing, which, if you think about it, if you or I could do that, that's all we do. But the issue is, if you have a circumstance like that, the federal government requires that you rebate any profit that you make. So let's say you borrow at 2.5 and Lisa can invest at 3%. That 0.5% profit has to go back to the federal government, unless you can spend the proceeds of the borrowing within certain time frames. And so that becomes a factor to consider in terms of, okay, how much should we borrow and when, so that we can meet those safe harbor spending tests. The flip side of it is, if you don't make a profit on the reinvestment, and right now I don't think you could, if you borrowed at 2.5%, I think Lisa would tell you that the current investment rates that she can get out in the market are well below that. So there's no chance of making a profit, and therefore you don't have to worry about rebating. But it is a factor that you'd consider. So those are a couple of items. You know, the other is that if you were to borrow before you had your bids in and all the contract amounts were known, let's say, just a hypothetical, we borrow $50 million, and then the contract goes out and you've got a total appropriation of about $115 million for this project. Let's say those bids came in at $125 million. You don't have appropriation sufficient to do the project under that circumstance. You've already borrowed $50 million. This may be very unlikely, but everybody's got to understand what the rules of the game are. You can't sign a contract unless you've got appropriation sufficient to cover all those costs. So that means that you've borrowed the money, you can't spend it because you can't sign the contract until you either appropriate more money at town meeting to cover that difference, or value engineer the project down to a level that the 115 million is gonna cover the cost of the school. And either one is probably unpleasant in terms of having to go back, if that happens, to either to town meeting or to build the school in a way that wasn't originally scoped out. Again, this is maybe highly unlikely, given the fact that you've built in contingencies and had professionals scope out the cost of the project. But it's important that everybody understand what the rules are. The other instance is if, for instance, you couldn't get the town meeting to appropriate more and the project couldn't be engineered down to a level where that was acceptable. You can't just pay back the money. You have to, the long-term bonds typically have a 9 or 10-year call feature, meaning prepayment option. So you're stuck paying those principal and interest payments for 9 or 10 years before you have the ability to prepay. Now, what you could do in an instance like that is keep trying to go back to town meeting, or go to town meeting and appropriate those borrowed funds to another project for which you could borrow for a similar term under the law. So I don't mean to be gloom and doom, but I think it is important, because you're making this decision about borrowing a sizable amount of money now before all those final construction costs are known, that you sort of know what the risks are, even if they're unlikely. So, does that sort of get us
I think so.
where you think you want to be?
I wanted to make sure that everybody's aware of the risks involved in this. Peter and I talked a lot today about the risks, and he focused a lot on, just think of what happens if your bids exceed. One thing I'm looking at right now, Brian, who developed our budget, our project manager, built a $4.6 million escalation cost into the budget. He also had 6.7 in contingency costs. When I look at those two, you add them together, that's about $11.3 million in additional extra money that's in there as a buffer. We also have some options that we took advantage of. I believe it was in the fire station. We debated whether to have 5 bays versus 6 bays. Brian, I think if you recall, we actually we did an alternative there as part of the bid price to add an extra bay in there. We ended up going forward with it, but we can make that decision. So we can have some add alternates in the bid to give us an insurance policy, basically. 2 or 3 few $1 million items. I don't know what those are off the top of my head, but Brian has a history of working with us and coming up with that, just to build that in there in case, because I don't want to be in a situation where we have to go back to town meeting or the voters and ask for additional money on this one. I never would be in a situation like that, so I want that extra insurance policy in there, so that's it for me.
Okay. Brian, can I ask you a question? Like, during design, so I know design's gonna kick off, you're gonna get into all the details. Are they gonna be keeping a track of construction costs along the way? So I'm assuming you're gonna have a pretty good idea before we even go out to bid, the current state of the market, where we stand, and if you have to do some value engineering to get some of the costs out, or if you're in good shape. So let me turn it over to you, but that's sort of my question. You know what, there's a portable microphone over here you could use too.
Yes, we will do 3 estimates, both Compass and eventually the construction manager, along with the designers during design. We'll do one at 100% design development, and then we'll do 2 during construction documents. The second of which will be a 90% construction document, so just before full completion of the project design and before we go out to bid for the trade contractors. Along the way, we'll be working with a construction manager who will be helping us with those estimates, and they have the input from real market data, what they're seeing for cost of materials, cost of labor. So at those points, those milestone points of doing those estimates, we will have the opportunity to either do value engineering at that point, see how that comes back with the next estimate, identify things that could possibly be bid alternates, as Jim mentioned. That gives you a little bit of flexibility on bid day. You accept them if they fit in the budget, or you don't accept them to help make the budget. So there will be opportunities throughout design to do those cost
Okay, thank you. So let me open it up for questions, and I'll go to Ben and Glenn first. Ben, do you have anything you want to add or questions right now?
No, I'll just comment, wicked quick on the information we just received. I mean, when you look through this packet and you consider the options, you consider the pros and cons, it really comes down to the two items that were mentioned, which was, what if the contract bids come in high? We've just discussed that, and I think that all that information is pertinent and I think fleshes it out fairly easily. So that is an issue that has been addressed. I think Brian just summed it up in about 90 seconds. So that's something that's been debated in every school building committee meeting, going back the last year and a half. It's something that was talked about leading up to town meeting, leading up to the vote. So that is something that we have a lot of data on. We have a lot of knowledge about where those bids are coming in. And I think I've said to a couple people leading up to town meeting, yeah, there's a possibility that the bids come in high, and then we need to address that. But it is a very, very low chance that's gonna happen. And if that occurs, then many bad things have happened leading up to that. What I did wanna touch on a little more was talking about the other item, or the other qualification of this borrowing, which is that we spend 85% of it in 3 years. And so that's why we had started talking about the cash flow, which is item 6 in this package. And that gets into, I think it was Mark that said it, excuse me, talking about, well, how are we gonna spend it? You know, the construction is gonna go forward, we're gonna get money, you know, every month to pay for that, to pay for the design, to pay for the construction. And, you know, when you look at this, it appears that, you know, it takes about three years and a couple of months to get to the full 115 million. But based upon this, and I'd love to hear more from anybody that has, you know, more knowledge in the accounting of this than I do, but it appears that we'll easily spend that money if the contract, the bids come in as expected, if we meet the schedule. Even if we did go, say, 6 months past the schedule the way it's currently arranged, we would still hit those marks as far as spending 85% of the funds. So, yeah,
I agree with you completely. In terms of the cash flow that's been provided,
yeah,
it's a pretty low bar to get
Yeah.
over. And the other thing to keep in mind is, from a spending standpoint, you don't have to count the MSBA receipts that are coming
Yep.
in monthly. It's, you look at just the amount that's been borrowed in order to meet those spending hurdles. So I agree with you very much that, given this current cash flow,
Yeah.
that's not really an issue. It's a rule that, you know, it's one of the rules of the road
Yep.
that has to be looked at, but in your case, it
Yep.
doesn't seem to be problematic.
okay. All right, great. No, I appreciate that. So, I mean, as I said before, I think we've met the bar on each of these qualifications, so I don't have any further concerns in it.
The other point that I would bring up, just because we had a chat just before the meeting began, is we'll definitely have a second borrowing at some point, and then probably a cleanup borrowing at the end, because the MSBA holds back 5%. So we may have to do a ban or something to borrow the money to finish construction to the end before we get reimbursed. So, you know, there's at least 2 more borrowings coming at some point. And the idea was just, what's the right amount for the first phase? So let me go to Glenn.
No, it's a good conversation, and I think it's heavily weighted toward a bigger borrowing, closer to the 50 million. And I think there's some risk involved, and I think we've addressed that. One of the things that I was curious about is the cost of holding on to that amount of money. And maybe it's a question for Jody, but, so with the arbitrage, or in the case where we don't need to worry about arbitrage, and we come in less than, let's say it's a 2% borrowing, and we come in less than that, I mean, can you get 1%? And what's the cost to, you know, it looks like in a year, we'll spend 15 million, and in 2 years, we'll closer to the full 50 is, the cash flow shows that that'll be fully spent. So maybe we need that first 15 million, so we're gonna hold on to $35 million, you know, beyond that first year. So what are the costs of holding on to that amount of money that we don't spend? Are we gonna, I mean, what can you get?
I think it was hard to come up with that because we don't know what the percentage to borrow later will be.
Right. So I guess the hypothetical, the rates go up by 1%, but we're not gonna spend, so we have $35 million that we have borrowed that we're not gonna spend, and we're gonna pay 2% on that for a year. So, you know, I don't know, if it was $100 million, that would be $2 million, 50 million would be $1 million, so like $800,000, I guess, would cost us something like that, to sit on that money for a period of time.
Yeah,
Is that right?
And I think the calculus, though, is that, for folks that are proponents of borrowing more, is you're locking in for 30 years, that 2.5%. And if you look historically at what rates are, if you don't lock in now and rates move up, and we don't know what rates are gonna do, but if they do, then you're gonna be locking in for 30 years at some higher rate, which has a considerable difference. To your point, if you're borrowing more than you need initially, because you've got a cash flow that you're gonna be spending this money, this 50 million, let's say, over a couple of years, yeah, you're gonna be in a sort of, under current market conditions, you're gonna be to the negative. Let's just I'm just making up numbers, but if you're earning 1%, or Lisa's earning 1% on the invested proceeds, and it's accruing at 2%, you know, somebody might say, well, why not just borrow exactly what you need and avoid that?
There's a gap.
It's because you're locking in for a long time, and you're betting that over the long pull, you're gonna be glad that you locked in at that low interest rate for 30 years, even if it means that you're losing a bit of an opportunity for the first year.
Yeah, for 1 year, so for 29 years, you get the benefit, but for the
Exactly
first year, you pay the price. Yeah, that makes sense to me, okay. That's all I have.
Thanks. Jim?
So, first of all, apologies for being late, couldn't be helped, and I know I've missed a lot of the dialogue that's already taken place, so hopefully I won't be turning over the same ground that you guys have already talked about. I buy the argument to borrow more, given the low rate environment we're in, but I think we need to do it acknowledging that there's risk in that. And that risk, in my mind, comes in really three forms. One is the risk of actually spending the money. So we have to spend the money over some period of time, which I think is 3 years, but I don't really know. And so if we don't spend it, then there's a risk of having to go back out and get it reauthorized, as I understand. So that is, no?
No.
What's the risk then
Oh,
of
I'm-
not spending it?
Yeah, the 85% rule is a reasonable expectation rule. So it keeps folks from saying, geez, we're gonna borrow money today for projects that we're not gonna do for 5 years. So the idea being that because the federal government is essentially allowing local municipalities to borrow on a tax-exempt basis, which means the interest that you pay to investors, the investor doesn't have to pay income tax on that. And so they're willing to accept a lower rate of return, which accrues to your benefit because your borrowing costs are lower. So, but that 85% test, and I'm sorry if I was confusing, is a reasonable expectation test, meaning that when you go out to borrow, you reasonably expect to spend it within those timeframes. What actually happens is sort of a different animal, and that's not it's not gonna hurt you, but you can't intentionally borrow funds today that you don't think you're gonna spend within that timeframe. So,
So there's no risk, assuming that we're honest with ourselves and think we can actually, that this is the right amount to borrow, there's really no risk of not spending the money in the 3 years.
right, and nobody's gonna take the money away from you. You don't have to reauthorize it.
Okay, that's very helpful, so that's my concern number one. Concern number two, of course, is that rates don't move up. It's possible.
Right.
Or they could go down,
Yep.
that's also possible.
And that's an important point, because this, you know, we're showing you some comparisons against, you know, a 4% interest rate, if rates moved up. We don't know. So it shouldn't be seen as, this is your choice, you want a 2.5 or do you want a 4? It's, do you want a 2.5 and avoid the additional expense if rates went to 4 or to 3, but they might stay at 2.5, they might go down. And so it's really insurance that you're buying by locking in now. You're not locking in savings. You're just avoiding additional expense if rates go up.
Yeah,
And we
so,
don't know
but back to Glenn's point on the cost to borrow early if the rates don't go up, that's a real risk.
Yes, if we knew with certainty that rates were gonna stay the same, what you might do is say, oh, well, let's borrow short-term, only what we need to meet our cash flow and not be in that negative position that we were discussing. And then when the project's all done, because rates aren't gonna change over that period of time, then we'd lock in that, and that would make perfect sense. The problem is, we're not at historic lows, but near historic lows in terms of interest rates. And the question before you is, given that you're near historic lows, should you lock in and mitigate against that interest rates rising? Or do you sort of, do a lesser borrowing and assume that interest rate risk going forward? And then also, and I'm not sure whether you were here, but we also talked about the unlikely event of, you haven't appropriated enough money for the project, your bids come in way too high, and now you gotta either go back to town meeting or
That's a risk,
change the,
but that's a risk regardless of the rate, so.
but it not in terms of timing. Because if you avoided going long-term and the project came in much higher, you can't pay the money back if it's a long-term borrowing. If it were a bond anticipation note, a short-term, like one-year loan, and let's say for whatever reason, the project got abandoned, you could use the unspent proceeds at the maturity to pay off the note, and, you'd be left with some amount that had actually been spent that you'd have to deal with whether you'd go long-term or not. We're kind of, the reason I'm bringing it up is just because it's a possibility, it's not a likelihood. And what Jim and I were talking about earlier today was, what we want to do is make sure that you folks have all of the possibilities laid out, and then make a decision understanding that there are some risks that may be very unlikely, but we don't want anybody to say, why didn't anybody talk about this?
Yeah,
when we're
exactly.
making this decision.
And so, it sounds almost silly to say rates don't go up or they go down, but that is a very real possibility. Over the last many years, we've expected rates to rise. They have not.
Yep.
And in fact, when they did for a short period of time, they rather quickly brought them back down because they ran into trouble with that. The current Fed chairman has been renominated to be the chair for another term, so I think you can expect to see that same kind of, attitude toward interest rates, which is dovish, and which would tell me that the rates are not likely to move up as much as if someone else was in the chair. And it's an election year coming up too at the midterms. So all of those things would argue against not having rates move up. That said, long-term, they almost certainly will move up. So the hedge over the 30-year period of time is really what we're talking about, not over the very near term. But it is a very real risk, and so it's something that, for the record, we need to have talked about, and we have. There's also the risk that the rates might actually go down. It's very unlikely, but it is risk, and so we have to have talked about that as well. So I think the real question here is, and so my third point, which you've already actually covered, is the risk that the project doesn't get done for some reason. I have no idea what that might be, but you always have to be thinking, what if it doesn't get done? What if something happens and it doesn't get done? And you've borrowed $50 million. Now what? So that is also a risk that we have to acknowledge. Small, tail risk, got it, but it is still a risk, and one that we need to be aware of as we decide what to do here. So I don't really think I have any further questions than what has already been talked about here, and I've read Jim's notes. I think it's really now a question of what do we, where do we think where's the sweet spot here? We balance off the risk against the opportunity to take advantage of the low rates. That's really what it comes down to.
Thanks, Jim.
Yeah, thanks.
So what I'm going to do is go around the room, so if anybody has a question, to help clarify or understand the issue better, I'll give everyone an opportunity. Susan?
I don't have any other questions. I think it just becomes a difficult task of, deciding where the risk lies and what's our best bet. But you've been very helpful in explaining the pros and cons.
Let me go to Mark.
Just looking at the cash flow, so if you went with the 20 million, you'd be going through the same process next November, lining up the next borrowing, which would probably be a $30 million borrowing to get you to basically January of 2022, when you'd have to look at your next borrowing. So the real key is, do you think interest rates are gonna move at all between now and a year from now? Because that's when your next borrowing would be to get to your 50 million of borrowing. And I'm guessing that there would be some movement. That's just my gut instinct, but I would recommend going for the 50 now.
Mark? And just say pass. If you don't want to ask any more questions, it's okay not to, so.
If you borrow the 50 million and for some reason the school project gets delayed, the town has the obligation to pay the interest on it, but then the town doesn't have to hold that money just in case schools come up. You could do whatever you want with the money.
So what you're saying is if the project didn't get done, was never going to get done, and we had borrowed that money, I think the answer earlier was that money could be put toward another project, because we're at that point committed to pay off the bond until the call provision, which is, I think somebody said 9 years, so.
I guess what I'm wondering is, could the town take that money and invest it itself? So you can somewhat mitigate the risk?
The town will get the money at closing. So our hypothetical is you borrow $50 million in January. At closing, $50 million will be delivered to Lisa. She'll invest it, and she'll be sort of the custodian of that as the project gets done to meet all the expenses. And in the meantime, funds will be coming in from the MSBA that will also go into that pot to be dispersed for project costs over the term. So there is some opportunity to earn interest on those funds to offset the cost, but under the current market environment, the interest you'd earn is not the same as the interest that you're accruing in expense.
Thanks, I'm all set.
So just to follow up on
Sure.
what Mark asked, so I think we do have a history of doing this once before. We borrowed back in the spring of 2012 for the library. There was about $950,000 left at the end of the project. In 2015, we reappropriated that money towards the police station. So I think that's kind of getting at what you might have been asking is, okay, let's say if it comes in $150 million, we can't do the project, but we've already designed it for $20 million, gone through everything, what do we do next? So that would be the leftover. We could reappropriate it like we've done in the past.
Is that what you were asking? I thought you were asking about investing it in the.
So my question was, one of, can we take the money and invest it and lower that risk thing? But again, I look at it and say the town has this opportunity to borrow 50 million at 2.5. Again, no one has the crystal ball. As a taxpayer, I'm comfortable with that decision because I probably have more concern about what will rates do over the 30 years. I mean, I'm old enough to remember stagflation back in the 70s, and we thought we'd never come out of that. Rates tumble, and with everything I'm reading, my concern is that the rates are going to go up, and we'll be sitting here in a couple of years going, "I'm glad we locked in," versus how much lower can they go? Just my thoughts on it. Thanks.
Mark?
Yeah, just.
And then I'll come back to you, Jim, sorry.
Just following up on that, where Jim brought up the case of the library, that wasn't a debt exclusion. If the school project doesn't go forward, the voters voted for a school. If we reappropriate the funds, does that nullify the debt exclusion
That was a debt exclusion.
for the
Part of
library?
Part of the library was.
Okay,
We borrowed $6.2 million.
okay.
Jim?
So just coming back to what I thought was your question, which is, you get the $50 million, you don't spend any of it for 2 months. I thought your question was, could we invest that money for the 2 months while we're not spending it, so that we earn something that gets us back some of the interest expense that we're also paying during that same time. And the question I was gonna ask, and I'm not sure to whom it goes, but I would assume that that investment would have to be a risk-free investment. So what would that investment, where would we invest that money in?
It would have to be, very liquid, investments.
Like T-bills?
Honestly, I've never invested in a T-bill, but it would have to be something I'd have to look at.
It'd have to be something
It has to be
that-
liquid, 'cause
And
all
it
of
has
a
to,
sudden,
has to have zero risk too,
right,
because you can't lose the money.
but it has to be, it has to be, all of a sudden they decide to spend, and it has to be liquid.
It's gotta have it, right,
Safety, liquidity, and yield are the basis of how I can invest.
So while there's likely to be some interest income that gets generated off that, it's probably pretty small, would be my guess, yeah, okay.
Yeah, the Mass General laws dictate what are the permissible investments for towns, essentially general funds.
Yep.
And those same laws would cover the proceeds of the borrowing.
Right.
So you can't buy stocks with it or anything that you'd
Not gonna
lose
invest in
asset value.
crypto or something like that.
Thanks, Jim. Boris?
Yeah, the only question I had was, so one of the risks that was discussed was, let's say bid comes out for 150 million, but we obviously didn't appropriate enough funds for it. Whether we borrow 50 or 20, you meet 150, you're still not meeting 150, right? So why is that even a risk?
Well-
At this juncture, it's.
In that example, if you're locked in for 20 million, and some of these expenses, I think, are related to sort of near-term costs, the design elements and that kind of thing, that you have to do in order to figure out get the bid documents, and I'm the wrong person to be talking about all the details of that, but, so I think you've gotta sink some money in, either way, just to get you to the point where you can bid out the project. And so that's the kind of the 20 million example, as opposed to going into the 50 million. Now you're in a position where you've not only covered those necessary preliminary expenses, but you've gotten to the point where, unlikely as it may be, that you determine that the project's gonna cost way more than the town is willing to pay, and you've locked in 30 million unnecessarily. And again, you know, in a sense, I feel badly that we're spending so much time on things that are probably unlikely, but at the same time, I think people have to be aware that as remote as that risk might be, that at least we talked it through and everybody got comfortable with saying, okay, I get it. If we go with the 50, it's a little bit different, a risk profile than just 20.
Thanks. Bill Buckley?
Thank you, Mr. Chair. I don't have any questions, but I guess my old Irish fatalism would tell me that rates are, as a gut feeling, probably gonna raise them. 50 million often seems to sound like
Nancy?
I don't really have much either, except for the fact that, like, we've been talking about doing our estimates at 3.5% interest, so 2.5 sounds good. And, you know, but I was just curious, do we know what other towns have done recently? Like, given the same choice, are people leaning towards the bigger borrowing? Yeah.
Quite a few have accelerated their projects and the financing of the projects and having this exact same discussion. Middleton is coming to market with the municipal complex in the next week or so for 66 million, and it's the exact same sort of thought process, that there's concern that rates are rising. You know, we're seeing some inflationary pressure that you can hear on the news. The Federal Reserve is talking about tapering its bond buying, which not to get too weedy on you, but they buy billions and billions of treasury securities in order to reduce the yield. They create more demand for it. It drives the prices up, but the yields, the interest rates on them down, and that keeps interest rates down. And they're talking about cutting back on that buying which will tend to let interest rates rise. So I think there are some arguments that can be made that says, you know, this is a really good time to lock in. By the same token, you know, if I were asked after 2008, when rates crashed, every year I'd be like, oh geez, you know, the rates have got to go up sometime, and I would have been wrong for 10 years. So, you know, so I don't purport to have a crystal ball.
Thanks. Bridget?
No, I appreciate all the different scenarios of what can happen, but after 8 years, I'm aiming for this project to be complete. And I support the decision of the board. So.
Okay. Mark?
I have no questions.
Jeff?
Brian, I'd ask that you just kind of refresh our memory on the current timeline of all the phases of the project. Because my initial instinct is that we borrow to our cash flow, which would take us mostly through design phase coming up into the end of 2022.
Right, so the current schedule is correct, you get the design phase first, which is approximately entirely all next year. We are looking at potentially doing some early construction packages towards the end of next year, kind of ahead of a full bore construction phase. So by the end of 2022, we will basically spend almost $10 million, $11 million in design and peripheral fees, starting construction, and then construction goes on from there for approximately almost 2 years. The new building opening in the fall of '24, and then it'll be finish up construction after that. We take down the old building, finishing up the site work, and then really this cash flow. Also, I think to keep in mind is this cash flow anticipates spending all of your contingency. So the project cost before contingency is $109 million, but with contingencies built in for not only construction but potential soft costs, the total cost of this cash flow for the exercise says if you spent every dollar, you know, how do we see that playing out? So I think you do have probably another year and a half till you get to that $50 million mark, and then you basically have completed the project by the fall of '24, so roughly 2.5 years out.
Thanks. Yeah, again, my gut is to borrow to the, you know, our cash flow, get us through design phase. That's my instinct. But I mean, again, I've only had 45 minutes to kind of digest the information since it came out, so.
Again, we're all hearing a lot of this for the first time, and in the end, it's the select board's decision, but we wanted to hear what the other boards that are heavily involved.
One more quick question. We've spent $1.1 million to date, but in the last 2 months, we've spent another $1 million on top. At least that's what the cash flow is showing.
Yeah,
We'll be at 2.1 by the end of
again,
December.
it's somewhat conservative and can, you know, front-loaded maybe for lack of a better term, that the design phase chunks will get a lot bigger in the next few months as they start that. So the design phase that we spent on that 1.5 is a relatively small amount. But now moving into design development, the architectural and engineering fees ramp up quite a bit.
Yep.
So this was kind of assuming if they really jump into it in November, there could be that first bill. So you know, we might be slightly behind this projection a little bit, but to be conservative, I think by the end of, definitely by the end of next year, we will have expended that 9%, 10% of design fees in full.
You good?
Another question for Brian. Are there any long lead items within this contract that might delay some of the spending, steel or anything like that, that would?
To be honest with you, the way the market is right now, it kind of varies. The big things that we're seeing are anything that's electronic, so anything from an electrical subcontractor, the big pieces of equipment that we want to get out the door immediately, and having a CM at risk contractor on board helps with that, because we're able to kind of get out ahead of that prior to kind of waiting for all the bids that come in, signing up a general contractor, then starting the process. The electrical switch gear, so kind of the big main switching components within the building. Believe it or not, roofing products right now have an extremely long lead time, to the point where some projects are kind of talking about what do they need to do temporarily, how can they work around getting materials in, when do they order materials, and then any type of lighting type of, anything that has any type of electronics that could possibly be coming, you know, with components that are overseas. Really the big one. Steel is actually relatively local and coming out of Canada for the most part. Things like concrete and labor, while the prices have kind of fluctuated, they're all locally sourced.
But there wouldn't be anything that would really delay this cash flow by such a factor that we
No,
wouldn't hit that
even
85%?
the electrical components I spoke about, they're gonna be kind of, the switchgear would be 3/4 of the way through the project. The lighting would kind of be at the end. They might try to procure that early and hold it, but from a delay perspective, you'll be a year into construction, or more before they, we have to make accommodations for something not being on time. And in theory, we're gonna know that kind of immediately. The goal is that you get those products submitted first, released first, so they can lock in actual delivery dates, and even though they might take longer than what you've experienced historically, you at least have it now, okay, it's gonna be this date, and I can adjust to it.
Thank you.
Ally?
Thank you, there's a lot of great information. Again, it's the first time we're kind of really talking through this. Each option has different benefits. I do kind of lean towards borrowing more for right now. I think that would be kind of a wise choice.
Great. Nancy, you have any questions? I know you came late and you were tied up earlier, but,
Yeah, work.
yeah,
I don't have any questions at this point, thanks.
okay. Any other questions or comments by the board?
So
Jim?
I guess I would just say that, having, and I did miss some of the early dialogue, but I think I'm pretty well caught up. We've discussed the risks. There's interest rate risk, there's project risk, and we understand those risks, we've acknowledged them. We have some of the smartest people in the town in this room, our finance people, we've got outside help on this, we've got FinCom and the select board here and others, school building committee. We've all acknowledged that these risks are there, and something that we needed to talk about and debate, and we've done that. I think it's reasonable to believe that rates will go up over the next 30 years. No one has a crystal ball, but I think it is reasonable to believe that. And so where I come from is acknowledging the risks, having had the debate, a reasonable view that rates will increase over the next 30 years. It seems to me that the prudent thing to do is to borrow the more money now, acknowledging that there might be some short-term, spend of, and loss of margin, if you will, between what we make and what we spend. But that's gonna get made up over the course of the 30 years and probably made up to a pretty big number, in truth, depending on what interest rates do. So all those things sort of have caused me to say, I think that the right answer is to borrow the more at the current known smaller rate, but understand that there is some risk in that decision. That's it.
Okay.
Okay.
So,
We have folks on the Zoom.
I'm sorry?
We have folks on the Zoom, you might want to ask.
Does anybody on Zoom want to ask a question? Sorry, I didn't mean to ignore you.
Call Jeff.
Okay, I'm seeing head shakes no. So I'm going to make a motion, and, I'll leave it open for discussion. Motion to direct the town administrator, the treasurer collector, and the finance director to move forward with a $50 million borrowing, plus anything else you want to add for other things that we agree to at town meeting, to borrow in the January-February 2022 timeline. Do I have a second for discussion?
Second.
Is there any further discussion?
Is it 50 million or is it 56 million?
Well, the miscellaneous that
The miscellaneous,
Mark
okay.
mentioned. It's
Yeah, so 50 million for the middle school project.
going to include the water pipes, the fire engine, and the
4.6.
road infrastructure work.
So 54.6 million, plus or minus.
Yep.
Okay.
So we have a motion to second. All in favor, please say aye.
Aye.
I'd say thank you to everybody who came. As we go forward on this project, we will try to keep you as a part of the discussion. If we have any more discussion to go on this, we had the same issue come up at our last meeting when we talked about ARPA funds. We'll be spending ARPA money over the next, 4 or 5 years, depending on how fast we get it. I will invite, Finance Committee, Capital Budget, any group that would have an interest to weigh in. In the end, that will be a select board decision, but I think it's important to get your feedback. Sometime in December, Jim will be sending out a list on all those ARPA-type projects, categorizing what is on the list, so you can think about it for a few weeks or a month before we get back together. sometime in January. So we are, at this point, looking to add things to the list, not take them off the list. When we get together, that's when we would likely, we have about $1.2 million, $1.3 million right now. So we may want to authorize in January the first project or two based on the money we have in hand. And then when we get more money, as an example, in June or July or whenever it comes in, we would probably reconvene, around that time and take a look at other possible projects. So feel free to, reach out to me or Jim or Ben or any of the other select board members if you want to discuss one of those things. But, these are both important things, the ARPA and the middle school, and we'll try to keep you all involved to the extent you want to stay involved, so.
I would also be interested in Finance Committee and Capital Budget, if they wanted to submit a list of projects that maybe we didn't discuss the other night, that they have at their tables, your tables, been talking about through the years, that you felt maybe just didn't make it to what we talked about, that, that wasn't the end all, that, as Mark was saying, we're adding, that I would be interested.
Yeah, I completely agree, and that's why, Jim's gonna try to get that list out in December, so people have time to come forward with other ideas and options. Same with the schools, as you think about things that are not already on the list, jump on board as well, so. So we have another motion, a motion to approve the MSBA middle school project funding agreement and authorize the town administrator to sign on the board's behalf. Do we have a second? So we have a motion and a second. Any further discussion? We have a motion and a second. All in favor, please say aye.
Aye.
We're gonna now recess. We're moving over to the main meeting room we're doing a public hearing on tax rates, so,
I'll make a motion to reconvene and recess, and reconvene in the select board meeting room, the main meeting room at Town Hall at 7:05.
I'll second that. We have a motion and a second. All in favor, please say aye.
Aye.
Thank you, everybody. Greatly appreciated.